All right, what's up, everyone? It's Eric with Option Edge, and today we're going to take things back to the basics. We're going to talk about buying and selling call options, okay? A lot of my videos have been a little bit more advanced, but for this, I want to just make a basic video that goes over everything you need to know about call options from someone who recently learned all this stuff, and so I think I have a good beginner's perspective. So let's get into it and get down to it. So just some different verbiage to go over. Call options are considered derivatives because they are derived from an underlying stock. Okay, so let's say Tesla. Tesla stock has Tesla options. Facebook stock has Facebook options. Facebook, the stock price, is the prime mover, and the prime mover of the options pricing. Okay, option prices besides stock movement have a couple other aspects like volatility, time, and things like that. But for the most part, mostly the stock is what's going to control the pricing of the options contracts. So these are called derivatives. Futures are also considered derivatives. And yeah, right here, stock prices affect call option contract prices, plus some other factors like a couple of other ones I mentioned. Moving on. So here's the formal definition of a call option. So a call option is a financial contract that gives the buyer the right but not the obligation to buy an underlying security like a stock, futures contract, currency, etc., at a specific price at any time until the contract expires. All right, so I highlighted these different things because we're going to focus on this part first. So this is what always trips me up. The buyer has the right, but not the obligation to buy an underlying security. What does that mean? So let's go on. The right, but not the obligation to buy an underlying security. So underlying security is talking about the stock. Okay, so when we're talking about let's say Tesla options. Okay, so you have the right, but not the obligation to buy Tesla stock. The right, but not the opposite. So the right means you have the right, but you're not forced to. You don't have the obligation to buy the underlying stock. Okay, so buying stock is referring to option exercising your options. Okay, so exercising means you're choosing to buy 100 shares of that particular stock, and the reason why it's 100 shares is because every options contract controls 100 shares of stock. Okay, that is the contract multiplier. Okay, so this sounds a little confusing. What the heck's exercising? Basically, at the exercising a option means that you're buying the 100 underlying shares of the stock. Okay, and you don't really have to know too much about exercising. Obviously, it's important, but exercising rarely happens. Okay, and there's a simple reason for it, but it's a little bit of an advanced topic that has to do with extrinsic and intrinsic value. So we'll save that for another video. Something else to keep in mind. So exercising it rarely occurs. So what happens is a buyer of a call can sell that call any point before the option expires. Okay, because every option contract has an expiration date. So let's move forward. And here's a simple definition that you have the call option gives you the right to buy 100 shares of stock at a certain strike price. Okay, so you have the right, but you're not forced to do it, but you do have the right. Okay, and at a certain strike price, and we're going to go over what exactly strike price means very shortly. So simple definition, continue. Call options allow you to get leverage exposure to an underlying stock. So if you buy a call option in Tesla and Tesla moves up, you will make more money than buying shares of Tesla most of the time, unless you buy a crap ton of shares. And there's some different mathematical ways of showing how the option, like I said, the option controls 100 shares of stock. So if you bought 500 shares and you have an option in one single option contract, well, the 500 shares of stock is going to it's going to be one more expensive, but it's also going to if stock goes up, you're going to make more money versus if you bought a call option. Okay, just because you have so much more money. But basically, for the price of let's say like $800, you can control something that's worth like $10,000 or $20,000 of stock. Okay, so that's what we mean by leverage. So with leverage comes great gains, but also high risk loss. Okay, so that's what's interesting about options. You can make a lot, but you can also lose a lot very, very quickly if you don't know what you're doing. So the strike price, with the strike price, we can control how much directional exposure we want by picking this particular strike price. So let's go to Robinhood to show this. Okay. We're going to look at Snapchat options. I'm just picking a random date. Let's do 50 days from today is December 17th. Okay. So as we look at this, this is the call option chain. Okay. So we have calls and puts. We can buy or sell. We can change the dates, December 3rd. This is the expiry date. So we're going to choose December 17th. So this is the date the contract expires, okay? And we are going to select buy, and we're going to do calls because we want to buy calls. So if you look, you see we have different strike prices, okay, on this option chain. The price of Snapchat is currently trading at about $54, okay? So that's shown here, and it's also shown here, okay? And you notice there's a line in the middle between here and here. So basically that is denoting that these option strikes are above the stock price, and then these option strikes are below the stock price. And another important concept to know when trading options is there's some terms called at the money, out of the money, in the money, okay? So basically, if we look at the $60 strike, it is out of the money because the stock is currently trading at $53, okay? If the stock was to get to that $60 mark, it would then be trading in the money or at the money. This $50 strike is slightly in the money because the stock price is above that 50 strike, okay? So that might be confusing, but as you trade more options and learn more about options, you're going to realize how important that is, and it's going to become a lot more simple. But that's just something to consider. So the reason why I came on to Robinhood is because we want to show those strike prices, and we're just going to show you the relationship between the cost of the strike, and then we'll also show how different contracts cost differently for different expiration dates. So going back to the strike prices, as we move away from the stock price, so we're trading at $54. If we look at the $80 strike, it's trading for 24 cents. But remember, like I said before, this is showing basically the price of one contract. You have to multiply that by 100 because the contract multiplier is 100. So really, this is $24. That's $24. This is $102. This is $190. Okay. So I might switch in from saying 24 cents or $24. Just know it's the same. Okay. So if we look at the 80 strike, it's trading for 24 cents. But if we look to the 55 strike, it's trading for $3.65. So why is this one so much priced so much more? Why is that contract so much more worth so much more than this 24-cent contract? And the reason is because in order to make money on call options, you have the stock has before expiration has to reach 80. Okay, once it reaches 80, do you start to make money? Okay, and I can show you that with this little profit and loss diagram that Robinhood helpfully shows. So right at 80 is when we start to make. It's really $80.24. Do we start to make some money? Let's show you. Let's do 60. Okay, if we look at 60, so in order to make money on this one, the stock has to reach 60 above 60. So it's 61.90 is where it has to get to. And there's a relationship between the strike price and the amount you pay for when you're trading options. And you can see that max loss is at the $60 when the stock goes to 60. We start to lose less money when we get above 60. We make money when we get above the strike price plus the cost of the contract itself. Okay, so as a buyer, in order to make money on December 17th, this stock has to move to $60 and above, really almost over $62 to realize some profit. Okay. And so basically the idea is as you get further away from the current stock price, as we get further out of the money, right? Because we're moving up and out of the money. If we look at the less the options prices cost, the contracts cost, because the odds of Snapchat reaching December 17th or reaching $110 by December 17th are very, very slim to none. Okay. But that doesn't mean we can still make money. Okay. We can still make money. So for example, we're on the $60 option. I said, hey, Snapchat has to get to 60 for us to make money. But what happens if Snapchat goes from 54 to, let's say, 56? Okay. It just moves up $2 in price. What happens to Snapchat then? So let's look at that. So I have right here, E-Trade. We have a profit and loss diagram. We're looking at Snapchat still. A call option, we're buying it to open. Buying to close means that you're closing the option. We want to initiate a call option position, so we're buying to open. So December 17th, $55 strike. So we're all set up here. So this is the profit and loss diagram. Here, this little gray line there indicates it's the zero mark. So anything above that gray line is a profit. Anything below that is a loss. Okay. And then we have a orangish line and a blue line. The orange line represents the date of expiry, okay, when the contract expires. But then we've selected tomorrow's the 29th, so a week from tomorrow is the 5th, okay, of November. So we're going to see, hey, what if we select we're going to say, okay, we're going to say $60 strike, $60 strike. We're going to say, hey, if we move from that $54, if we move to, let's say, $56 in a week's time, let's see how much that contract's going to be worth. All right, so you can see underlying price is up. That you can see underlying keeps moving away. Underlying price $56.05. So you can see P&L, profit and loss, on December 17th is actually a loss. But in the meantime, our profit and loss on November 5th will actually be almost $48. Okay, so that's what I mean. You can be, if you're right directionally, meaning if this stock moves up, we buy a call and the stock moves up. In the short term, we can actually make money. We can sell to close this contract and profit that $48. We'd select sell to close, and boom, we would be done. But let's go back. So yeah, we would make some money on that. But notice that if we don't, at expiration, if we don't get above the $60 strike plus how much we're paying for it, which is about $1.90, we're not going to make any money. So right here at $62, we start to make money. If we go under $61.90, we will lose money at expiration. Okay, so at expiration we lose money. But that, a lot of times we don't need to hold option contracts to expiration. If we get to just below 60 in a week's time, well, heck, we made $216. We can sell that contract and we're out. We got our money. So that's what's interesting about option contracts. Okay, let's move on. Simple definition. We got the strike price. Talked about direction. Okay, so we're going to get into delta, but when we're talking about directional exposure, just know that the farther away from the current price, the less directional exposure you have. And a good way of looking at how much directional exposure you have is the delta. I've made a video before that goes in depth about delta, so I'm not going to talk about it here. I'll link to it above somewhere. So you'll see as we get farther away from the strike, the current price, which is $54. So if we go, let's look at the $55 delta. So you're going to see it's about 51. You're going to notice so that at the money deltas will be around 50. Out of the money will be less and less than 50. If we look at the 65, it's about 20. Okay, so we'll talk more later about deltas, but that's that just shows you just know this, that the higher the delta, the more directional exposure we have. And we can control that directional exposure by selecting different strike prices. So if we go further out of the money to, let's say, 80, we will have less directional exposure versus a $55 call. Okay. Next thing I want to show you on the options chain on Robinhood is you have to pay for time. Okay. The more time you have as a call buyer, the more money that option contract is going to cost. Okay. So we're looking at let's go back to the $60 call, trading for $1.90. What happens when we go out for a month? What do you think is going to happen to that price, that contract price? Well, we go out to the $60. Heck, it went up $100. Went up $100 or $1. And the reason for that is we're giving us more time. Basically, we're giving us more time. So we selected the next month up. So we went from 289 to 445. So we're basically buying time. And the reason why time is valuable as a buyer is because if you think of it, you have more time to reach that strike price, right, and become profitable. Let's say your contract moves to the downside. Well, that's okay. You still have time, and there's a chance that stock could move back up. And you can think of it like this: if you're sports betting, and you place a bet right before the game starts, basically, if you place a bet before the game starts on let's say team A to win over team B, and then at halftime you see that team A is actually losing versus team B, the odds of team A actually winning are lower now, because now that you only have a half versus a full game to make up the loss. So that's sort of how options contracts work. As time goes on, you have less and less of a chance to make money if you're underneath that break-even point. Okay. All right, let's continue. Back to what does strike price mean? We've gone over a little bit about it. We're saying current stock price is 100. You buy the $120 call that expires in 30 days. 120 is the strike price. So we've been using Snapchat. We're looking at $60 calls that expire in 50 days. Current stock price is around $54. So basically, a strike price it's a bet between you, the call buyer, and the call seller. Okay, so for every call you buy, there is someone out there actually selling you that call. Okay, so that's important to know. There's a winner and loser for every options trade made. Okay, so it's a bet between the call buyer and the call seller. So as the buyer, you bet the stock will move up in 30 days, but it has to not just move up a little bit, it has to move up a lot for you to be profitable. But that doesn't mean in the short term, if it moves up even a little bit, and we showed you, if it moves up just $2 in a week's time, we were up like $48 on Snapchat. Okay. So you can, like I said, sell that and profit, and then you win that. And so like I said, yeah, you can still make money in the short term if the underlying stock doesn't go up. Okay. Moving on. So we talked about call options, and call options are very similar to stock in some ways, but in other ways they're not. Okay. So call options and stock price have unlimited upside potential. And this means that if a stock goes from, let's say Snapchat goes from $55 to $1,000, well, you're going to make money the whole time as we go up. Okay. What's different about call options and stock is call options have a limited time frame, whereas stock, you can hold a stock that's down you can hold it for years and be profitable, or you can hold for years and actually end up losing. Call options is short dated contracts. You either win or you lose within that time frame. So there's some advantages and disadvantages to that. You have to be right, but you also have to be right in a specific time frame. I can't tell you how many times I bought a contract, a call option. The stock didn't move, and then the call option expires. I sold it for a loss, and then a week later, the stock rips to the upside. So the money I put towards that call option is gone. Whereas if I had just bought a stock, and that stock moved up, I would have realized those gains. Okay, so that's sort of the differences between stock and calls. And there's no leverage with stock. Okay, and call options, you have leverage. And I went over a little bit about it as the higher the delta, so the more directional exposure you have, the more leverage you will have, and the lower the delta. So as we get farther out of the money, so Snapchat example is trading at $54, and we end up buying the $80 call. That delta is going to be small, which means our directional exposure is small. So our leverage is smaller, if that makes sense. Okay, so the basically the more in the money. So if we buy a $50 Snapchat call, we buy the $50 strike. That's going to be more levered than the $80 strike. Okay. Moving on. So long call characteristics, we're directionally bullish, just like if we were buying stock, longing stock, that's also directionally bullish. We have a positive delta, which means our directional exposure is in the positive direction. If the stock goes up, we make money. Okay. Something I haven't talked about yet, and that is time decay, aka theta. You can go to the options chain and see the theta value for each one. Basically, we're going to lose this contract here means we every day. So this is showing the daily value, every daily theta data value. It's a negative sign, meaning every day we are losing 2 cents or $2, almost $3 in theta decay. Okay, so I made a whole video about that. I'll link to it somewhere. Another thing, and I'll show you this on E-Trade. Call options benefit from increases in implied volatility. Okay, so let's show you that. So every underlying stock has an implied volatility rating. The more volatile the stock, the higher the implied volatility. So think Tesla is a super volatile growth stock. It goes up, it goes down like crazy, big movements. Whereas, I don't know, let's say like AT&T is like a well-established phone company. You know, they're not doing anything crazy innovative. It is what it is. That type of stock would have a lower implied volatility. So if we look at our option contract, so let's pay attention to that November 5th P&L. So right now we're looking at $216. Okay, with the stock at 60. So we're going to keep with the stock at $60.22. So we're going to keep the stock price the same, but all we're going to do is we're going to increase that implied volatility. So we're at $216 now of profitability on November 5th. So remember that, 216. We're going to increase this to 70. Okay, see how that affects. So we're going 20 points higher in volatility. So 216 versus now we're at 376. Okay, see the P&L? We're at 376. And you'll notice that the P&L on December 17th hasn't really changed, and that has to do with extrinsic and intrinsic value and all that. And like I said, that's a little bit more advanced, and we'll talk about that later. But as you can see, the volatility increases in volatility give you increases in option contract values. And if we go, that was at 40. If we go down to 20, so this was trading at 316, we split the volatility by more than half. We're at, notice if volatility drops, we're at negative $20 where we were at profit. So that just shows you how volatility works. And notice we're still at the same underlying price. Moving on. Benefits from IV increase. So we talked about unlimited upside. So your call option can go, if Snapchat keeps going up, we're going to keep making more and more money before the option expires. Okay, and that's similar to stock. The other thing is we have unlimited upside. We have a limited loss. So the limited loss part is, so for every time we purchase an option, we're paying. So this is going to cost me $445 to buy this $60 strike in Snapchat. Let me delete that one. So yeah, it's going to cost me this much. My max loss is the debit, is the amount I paid. So the amount you pay for a long call is called a debit. If you're selling, that's called a credit. We'll go over that more. So that's my max loss. Whereas if I owned 100 shares of Snapchat, I could lose thousands if it went to zero. Okay, so that's just something to keep in mind. Lastly, it has so when you buy a call option, you have a low probability of profit. All right. So let's take a look at probability of profit in my little count here. So we're looking at this. Might look a little crazy to you. I just want to make sure we're at these. Okay. We select let's select the $60 call and see what our probability of profit will be. This little thing. All right. This isn't right. It's showing 68. Before it was 31. So it's just showing that you have your probability of profit. It was 31 before, means you have a 31% chance of making a single dollar on that trade. Obviously, once you want to be, obviously 31% means you're more likely to not make money. Okay, so that's what I mean by lower probability of profit. So it's weird. I don't know why that did that. Why did that do that? Let me pause this. Anyway, not sure why that's doing that. Sometimes it's funky. All right, low probability of profit. Moving on. And then this is just a diagram of a long call. Okay. And here's our P&L graph. We talked about this a little bit, but you'll notice the strike price. So on our Snapchat example, if $60 is our strike, the point at which if our stock is trading at $54 and we don't get to at least $60 upon expiration, we're going to lose 100% of that value. Okay, but once we get over the $60, we start to our loss becomes lower and lower, and then the break-even point is going to be the debit paid plus the strike price. So let me swap these slides around because I know this says right here, it says calculate the break even. So we're looking at, this is from a little bit longer ago. I put this up here a couple days, but actually right here calculates the break even. And I'll just show you the relationship between our strike price and the debit paid and break even. So if you look at strike price, right here, it's the $55 strike. Debit paid $3.05. You add those together, 55 plus $3.05. It's going to yield $58.05. So if you're buying an option, you have to not only get over that $55 mark, because remember, it's a bet between you and the seller. The seller is betting that you're not going to get, that the stock isn't going to get above 55, and you are betting that the stock is going to get above 55. But as the buyer, it costs you to place that bet. It's going to cost you $3.05 or $300 to place that bet. And basically, you have to not only overcome the $50 strike, but you also have to overcome the debit you paid. Okay. So in many ways, and this is why the probability of profit is lower for when you buy options. And that's because you have to not only surpass the strike price, but you have to surpass the premium paid as well. Okay. So many people make a lot of money actually selling options. So we will, we'll go into that a little longer, but, or a little later, but, let's see here. So let's do another example, one more break even and in Snapchat. So we were looking at the $50 call. So now if we look, $60 plus the price we'd pay to buy this is going to be $64.45. Okay, so let's take a look at that. And if we look, remember our slide here, okay, we're just going to look that up in Robinhood, and it's going to be very similar to this. So the point at which we lose all of our money is the strike price. That's the point where we lose all of our money. Once we get above that, we lose less and less. So you can see we lose all of our money. See the expected P&L here. So that's all of our money. We're paying $4.45 for that, $445 for this contract. And then in order for us to break even, we have to get over $64.45. Now see here, right? Boom. That's that at this point, we're making $0. So if the contract expires and the stock is exactly at this, we are making $0. And then once we're above that hump, we start to make money at expiration. And remember beforehand, you can still make money if Snapchat just goes up a little, but doesn't go up quite as high as this amount. You can still make money in the short term. Okay. But at expiration, you wouldn't. Okay. So, all right. So we'll dive a little bit deeper. We talked about delta, and you know what? basically the higher the delta, the more the option contract costs, and basically the higher the delta and the longer the date of the option is the most expensive version of the call option. And the opposite holds true, that the lower the delta and the shorter the date, the option, the less expensive it is, or the cheapest it is. Okay, so we're on the February 18th options chain. If we go out, I think I already showed you guys this. If we go out, this is now worth more. If we go down, which is higher in delta, look at the delta, 94 delta is going to be, that contract is worth $25. We go back up, this is a 66 delta. That contract's worth almost $10. So you can see the difference. And if we go, so the cheapest contracts are going to be the ones that are nearest in time, shortest time duration, and the furthest, look at that, furthest out of the money, the 115. So it's trading for a cent. These are all trading for a cent because they're so, it's just so not likely that we're going to see a $50 spike. And literally, this is tomorrow. Okay, this is tomorrow in a day. We're not going to see a $50 spike in Snapchat. Okay, so that makes sense. Okay. And then our max loss, we talked about this, is the debit or the price you pay. So here we're looking at this option, going back to, I forget where the heck, this is the February 18th, 2022, $60 call. It's going to cost us $4.45. So our max loss is what we paid. Okay, cool. Moving on. So let's summarize how you make money and how you lose money. And we already talked a little bit about this. So if the underlying stock stays at the same price, our calls, not our calls are going to lose value due to theta decay. Okay. I made a video about theta decay. I can link to it, and I'll link to it above or in the notes. So let's look at theta decay. So let's go back to the normal. I'm going back to the normal vol just to keep things normal. So the stock's currently at $54.39. So we're going to set our little bar to just above that, $54.42. So we're a couple cents higher. If you notice, if the stock barely moves a week from now, we're going to lose. Put that back. We're going to lose like 11 P&L on November 5th. Our option contract is going to be worth, it's going to be 11. It's going to be down $11, and that's because every day that passes, theta decay chips away at the option value. And as we approach as we approach the option's expiration date, which is on December 17th, we approach zero. We approach if the option contract is not at that strike price, like the $60 strike price, the contract's going to lose more and more money due to theta decay. Okay, so that's something to keep in mind. Okay, so that sums up buying options. Okay, so I forgot to go over the other parts of it. So if the underlying stock goes down, our call is going to be worth less, and that makes sense. And we can just show that here. Stock price goes down both on December 17th and November 5th. We're losing money, right? Makes sense. Okay, we talked about if volatility increases, our call contracts go up in value, and if volatility falls, our call options go down in value. And then if the underlying stock increases, your call value will increase. That's sort of summing up everything about buying calls and how do you make and lose money in calls. So now here is selling calls. So I made this video together because selling calls goes hand in hand with buying calls. Okay, so every time you sell a call, you're going to receive a credit from the buyer. So let's look at that. Let's look at that in Snapchat. There's a call buyer who's going to buy the call for $4.45. And as the seller, you're going to receive this as a credit. Okay, so that goes in like right when you sell this, you're going to have $445 more of buying power in your arsenal. Okay, so you literally receive a credit. Okay, and you receive a credit, and So the call buyer pays the debit, which ends up being your credit. Okay. Credit is the compensation for taking on risk. We'll talk more about that later. As a seller, to make money, you want to sell at a high price and buy back at a low price. So that makes sense. If you're, how do you make more money in life? If you sell very expensive things, if you sell Ferraris, right? You're going to get paid more for them. Okay. And then when you want to close the trade, you buy it back at a lower price. Okay. That should make sense. And then as a seller, on the flip side, we talked about how the buyer has the right, but not the obligation to buy 100 shares of stock at a certain strike price. Well, in this case, the seller actually has the obligations to sell the 100 shares of stock to the call buyer if the call buyer wants to exercise his option. Okay, so hopefully that's not too. That's maybe the most the hardest concept. So basically, if the call buyer, we'll go into it more. So let's continue. So here are some of the characteristics of a short call, of selling calls. So unlike, so we talked about with buying calls, we're directionally bullish, meaning if we want the stock go up. As a call option seller, we want the stock to go down below our strike price. So let's say we're selling this $60 strike back in, we're looking at February again. As the seller, we're going to select sell here. So we want the option to stay below that $60 strike, right? See, we make the most money as long as that stays below that $60 strike. So directionally bearish, we have a negative delta, meaning our direction is to the downside. I mean, we make money if the stock goes down. We lose money if the stock goes up. We have what's different about the call buyers is now we have positive theta decay rather than negative. And we can look at our theta symbol here. It's still showing negative. It should show positive. So that means every day that occurs, we're going to, the value of our contract is going to decrease by like $2 or $3 a day, which is good. We want the contract to go down because we're selling an expensive option and we want to buy back this option at a lower price, okay? Or let it go to zero. That's the most optimal outcome. We literally, the stock, the option contract, we sell it for $4.45. And then as long as it's below 60 at expiration, it's worthless, the contract. And that means we keep our whole credit, okay? We benefit from a reduction in implied volatility. And that should make sense because we showed that options prices go down. So if we're here, okay, look at the November 5th date, the P&L, $338, okay? If we decrease, we're going to go from 50 to a 10 implied volatility, which is a huge decrease. And you can't even see it. Let's go to, let's say 30. So 50 to 30, we went from 300 to 177. So it's worth 50% less. So as the option seller, we want the contract to go down. We benefit from that. So what's different, a long call has unlimited profit, whereas the short call, the only profit we can make is that credit received. So so basically what happens is the call buyer gives us the credit. And the way we make 100% of our money is as long as the option expires worthless, we keep that entire credit the option buyer gave us. Okay. And then on the flip side, we actually have unlimited loss. So we can lose as a call seller if let's do sell to open. Hopefully if the call goes up and up and up in value, you can see we are losing more and more. So basically, a stock can go to infinity, right? Snapchat could go to $1,000 in 2 months. I mean, it's not likely going to happen, but theoretically, it's possible, right? If they invent the cure for cancel Snapchat, I don't know why that would happen, but and let's say the stock went to $1,000, we could keep losing. And if it keep going up, we keep losing. So that's the downside of selling these options. But on the other hand, we have a higher probability of profit, and that's because, and we showed this before, the to make money as a seller, the not only does the call buyer have to be right about our strike price, but he has to also exceed the debit he's paying. All right. So he's got to get above that strike, and he has to exceed the debit paid in addition. So that's sort of our edge as a seller. Okay. And then here's the P&L diagram. So as the short call seller, so here's our strike price. Let's say it's $60. Our max profit comes as long as we stay at 60 or lower. Once we get above 60, then we don't make quite as much money. Once we get to the break-even point, which is the strike plus the credit or the debit paid, then we lose money, and it's unlimited loss. And yep, showed you that. Short calls continued. Max profit is credit received. Max loss is unlimited. Robinhood. Okay, another interesting thing to know is Robinhood will not let you short calls unless you own 100 shares of the underlying. And this sort of makes this, you might say, why is this the case? Well, if you don't own 100 shares of the underlying stock, you can lose unlimited amount of money. So no one has an unlimited amount of money. Even if freaking Elon Musk wanted to short a call on Robinhood, he would not be able to. Okay, on other different options exchanges, they allow you to do this, but the only way you can short a call is if you own those 100 shares of underlying stock. Because at the end of the day, if as an option seller, let's say you're selling that $60 call and Snapchat goes up to $65, you have the obligation to sell the call buyer. If the call buyer exercises his option, you have the obligation to sell 100 of your shares of stock to the buyer. Okay, so that's sort of how it works. And that's why you need to have the 100 shares as collateral, basically. Okay, so when do you lose? And we talked about this. If the stock price goes above our short call strike, you will be forced to sell 100 shares of that particular underlying at expiration. The shares are called away. Okay, that get bought or sold off to the buyer, the call buyer. And this is just showing you how, as a seller, our probability of profit is higher. Remember, we were looking at before, it was like 31. Now it's 69. Our theta is positive rather than negative. We have a negative delta. So again, just to reiterate how we make money off of short calls, the underlying stock drops below our strike. Underlying stock stays at the same price, and then we benefit from theta decay. So we talked about this as the buyer. If that stock is trading at, where's the trading price? Trading at right at the price of here, and then we current price is 54.39. And if we let's see here, let's do like a couple weeks from today. If that stock doesn't move, look at how much money we'll make. We'll make $166 on November 26th, and at that point we can actually buy. So we initially sell to open. To close out a call, you buy to close. Okay, because remember, we're selling high, and then you have to buy back at a lower amount to make money. Okay, so that's another interesting thing. As a call buyer, or excuse me, as a call seller, we actually can sell and close out this contract if we're up money. So yeah, like I said, this is back to buying to close, sell to open, analyze. So yeah, if the call starts going down, if the call goes down a couple dollars a couple weeks from today, I will make $180. I can buy to close, and then I keep that $180. Okay. And we already went over break even. So yeah, basically that's sort of call selling and buying. I feel like we went a little bit more depth into the call buying because I feel like that's more the most important thing. But we talked about call selling. I'm trying to think if there's anything that I'm forgetting here. Directionally bearish, positive. I think we talked about the theta decay. Yeah, I think that's it. Please, if you guys have questions, ask me in my comments. Like and subscribe to this stuff. And remember, this is for educational purposes only. Alrighty, peace out, have a good night, and take care.